Good evening, one and all, and welcome to the Fall 2021 edition of the Investor's Guide to Thriving. We're back again for the fourth time doing this event series online, and our days of touring the country doing these talks live are but a distant memory from 2009 to 2019. Well, since our spring webinar series, most Canadians have been vaccinated and are trying their best to get back to the way things were before the pandemic, which may have explained last month's election result, which cost $600 million just to bring us back to the 2019 status quo. Well, hopefully we'll accomplish more on tonight's program as we try to educate and enlighten our investor audience about what's going on in the global economy and markets. We've got a great show for you tonight as we kick off this weekly series that'll be coming at you every Thursday at 7 p.m. Eastern until the week of December 9th. But I'll give you one evergreen tip right now. Don't wait until then to buy your Christmas tree, because like real estate, oil, and semiconductors, apparently there's a shortage of those too. Of course, our content, as always, is going to feature Mr. Larry Berman, host of Berman's Call on BNN and our Chief Investment Officer at ETF Capital Management. But today's special because we have not one, but two Larrys on the webinar. That's right. Larry B will be joined by Larry McDonald, who, for those of you who don't know, is a New York Times best-selling author, CNBC contributor, political risk expert, and creator of the Bear Traps Report. Together, they'll review the Lehman 21 systemic risk indicators, make some bull and bear market picks, and of course, answer your market and economic questions. So off the top, I'd like to take a moment to tell you a bit about our group of companies. It all began back in 2006 when Larry and I launched ETF Capital Management, where we do two main things. Firstly, we partnered with BMO ETFs to manage the Sleep at Night ETF and funds of ETFs, which are available through your financial advisor or online brokerage. And we provide holistic family wealth planning and portfolio management directly for those with portfolios of 1 million plus. You can learn more at etfcm.com, where we just launched a beautiful new iteration of our website. If you're looking for pure fee-based financial planning services, UPotential is our solution to that need, and Golden Girl Finance is our digital media site specializing in finance content by women for women. Lastly, Q Wealth Partners by Quintessence Wealth is our advisor platform, providing a cutting-edge alternative to traditional independent brokerages. ETF Capital Management is in fact the original partner, but we've since been joined by 10 other advisor practices from coast to coast. And these days, it seems like we're adding at least one a month as word spreads about our innovative wealth tech capabilities. Well, turning back to the Investor's Guide series, Larry and I would really like to thank those of you who have joined us in support of childhood leukemia research at Sick Kids and Alzheimer's and dementia research at the Baycrest Foundations. With your help, we've been able to raise over $450,000 for Baycrest and about to break $100,000 for support of Sick Kids, which we added in more recent years after they literally saved my daughter's life in 2016. I am so eternally grateful to Sick Kids and to all of you who have made donations. Now, if you'd still like to make a donation, please use the links in the survey you'll receive after the event. That's how we're able to track and match your generosity. That survey is also your gateway to access the webinar replay, which will arrive in your email tomorrow morning. Tell us how we did, and you'll get a link to access all of the above and submit questions for next week. Investor's Guide to Thriving is brought to you, as always, through a lot of hard work, and let's not forget sponsorship. A big thanks go out to BMO ETFs, our top sponsor and our partner in ETF education since 2009. Here to share with you a slew of interesting ETF facts is our good friend, Calgary-based biking safety expert and director at BMO ETFs, Mr. Rob Butler.
Jared, thanks very much. Interesting introduction. You're putting pressure on me to step up my cycling game, I guess. But thanks everybody for joining us tonight. It's nice to kick off the fall season, having been doing these types of presentations with Larry's group for over 8 years now. And granted, we're still doing it virtually. Hopefully we get back to seeing the great crowds that we were pre-2019. In the meantime, today's topic, we're going to be looking at liquidity and trading. And let's just take those two topics and keep them relatively general. I want to take a high level approach to what I think it's important for you as investors to be thinking about. And for those of you that aren't well versed in the ETF or exchange traded fund side of the business, hopefully you'll get a few tips along the way. I'm going to spend about 10 minutes here and just touch on a few different slides. And to kind of kick it off, I think it's important to give you a sense for the ETF space here in Canada. What's amazing is I remember starting with BMO back in 2013 and 2014. And at the time, when you looked at the number of ETFs that you could have chosen, you were looking at maybe 70 to 90 different ETFs, including every provider in the Canadian market. Today, that number's over 900. You can see that in the bottom right of your screen. So, my takeaway from that is I just want to encourage you that if you are going to be using ETFs or you're new to the ETF space, you really do need to do your due diligence to make sure that just because something has the word dividend in it, I want to make sure that it's the right type of dividend and how those portfolios are being constructed are in line with what your objective is. Now, some of the bullets here we have including the 100 largest ETFs in Canada make up almost 70% of the market. So all that means is if you think of the 900 or so ETFs that are out there, 100 of them make up the bulk of what's trading on any given day, as well as the assets under management. What's interesting is looking at 78 of those listings are now over $1 billion in assets. And why I think that's an interesting number is I remember, again, looking back 5-10 years ago, it was often the case where we'd have to justify and reassure clients that the scale and the size of the ETF was not going to limit them in terms of their trading capabilities. And you'll recognize that just based on the growth of the business alone, so many of the products that are in that market are, again, surpassing $500 million to $1 billion now. So it kind of reduces any concern for trading execution, whether you're buying or selling an ETF. Almost 400 of those ETFs. So this is an interesting stat. When you look at the 900, it sounds like a lot, yet almost 400 of them have less than $20 million in them. So I will break out what I want you thinking about rather than getting hung up on the 20 million piece, because some of those are really new ETFs that are going to take some time to grow their asset base. I'm going to try to highlight some aspects that you can be thinking about rather than getting too hung up on the size of the ETF itself. Of the top 20 ETFs, they account for 50% of the market. And I think you're probably familiar with some of those names. I mean, many of the what we call beta type products that track an index in the form of the S&P 500, the TSX 60, that's where typically the greatest size and tradability of these products come from. And they do make up a lot of what traders are doing on any given day. And then just the last bullet there, 2 most traded ETFs in Canada in May. So this is kind of interesting. I mean, when you look back of what we've been through in the last year and a half, where are people buying or selling and where's the activity coming from? XIU, one of our biggest competitors over at BlackRock, just buying the TSX, and then ZEB is ours, and that's the equally weighted Canadian bank ETF, which account for, you can see there, 20% of volume at any given time in the month of May. And on the next slide, this is something that I think not that we forget about, but for those that just take for granted the back end of what an ETF is, I think it is relevant to understand the, let's call it 3 different levels of market making and trading and market makers. So let's just go through this really quickly. When you look at buyers and sellers, let's assume Larry Berman has $10 million of a particular ETF, and I'm coming into the market and I want to buy 1 million of them. If Larry's selling 1 million of them, or he has them on the board for me to buy, then that's just, let's call it first level trading, where the ETF will just exchange hands based on Larry and I doing that trade through the exchange. Now, if there isn't quite as much volume, often a market maker is going to post units at a particular price that reflects the spread of that underlying security. So the market makers and all of the institutions here in Canada, being the likes of RBC, Scotia, they all have a group that are responsible for this, and they're going to be able to post liquidity or volume and show out to the investment base what's actually available to buy or sell. And then the third level, this is important. If you've heard the word creation or redemption units, this is what really allows the ETF to work in the way that it does. And what we mean by that is, I'll go back to the example of Larry coming in for $10 million to buy something in this example. Let's assume that there wasn't 10 million units of anything available in terms of what it was he was trying to purchase. In that case, you'd actually have the ETF provider come into the mix and have to create units of that ETF for Larry to be able to buy. But then the same principle holds true on the other end. If Larry needed to redeem 10 million and there was no actual buyer for that, the ETF provider would step in so that you can keep the overall correlation between what that ETF is trading at and being sure that someone can actually trade it. And that's what allows the ETF to track NAV or track the underlying value the way that it does. On the next slide here, what I think is an interesting takeaway, and what we've done is we've taken ZEB, so I referenced that a few minutes ago being one of the more widely held ETFs out there. We talk about the volume of the ETF in and of itself, and it is relevant, and I think it's important to know what that looks like at any particular time. But to take it a step further, it's actually the underlying securities that are more influential to how that ETF's liquidity actually behaves and what you're getting access to. So in the case of ZEB, we own the biggest 6 banks in Canada. We own them in equal weights, but then that's what that chart at the top shows. And if you go down to the bottom, it actually shows the volume of any one of the individual 6 banks that we hold and how frequently they're trading. So what's kind of cool is you can go to Thursday, June the 17th in 2021. You can see that there was 2 million units traded in the case of the ETF in its pure form. Yet if you go down to the exact same date and you simply look at each of the banks that we have listed there, and again, these are the underlying securities, you can see that alone Scotia traded over 10 million units that particular day. So that's the number, and I kind of mentioned this at the start. I don't want people to get too hung up with the size of the ETF. What is important is that what you're buying, that there's liquidity underneath that ETF. And I think the Canadian banks is a perfect example of that, where there's actually more volume in the underlying securities at any one time versus what you might be seeing in the ETF in and of itself at a certain point in time. So then you move over to less liquid assets, whether that be in the case of fixed income, which is a huge part of what BMO's actually responsible for in the ETF world. If you go back to the month of September, we did more fixed income business than we did equity business. And for that reason, it's a little bit different than what I just demonstrated in the case of Canadian banks, where most fixed income that you're going to try to get access to doesn't really trade on an open market. So you can't go to the exchange and buy a bond that you see trading. It's actually done over the counter and often done through a dealer or a portfolio manager that can do it on your behalf. So what's wonderful about an ETF is not only has it increase overall liquidity in certain parts of the fixed income market, but it's also an access point for us as investors. I couldn't have gone out 5 years ago and constructed a proper bond portfolio on my own, where now I can actually pick a very targeted segment of the fixed income universe, whether it be Canadian, US, international, or emerging markets for that matter, and I can buy one unit, even though it's tracking multiple bonds underneath. So the double benefit to us is, one, I can access fixed income, which I couldn't have on my own 5 years ago, and the spread and liquidity is far superior to what it would have been for the likes of you and me versus a traditional institutional client back in the day, let's call it. So it's really commoditized what it is we're able to construct in our own portfolios ourselves, and by way of transparency as well. I mean, I'd love to know that you can go onto our website at any given time, and I would say most of our competitors would be similar, is you can see what that ETF is holding. And I think that's incredibly important, so you have reassurance on what it is that you're buying. And do know that in the case of BMO, what we say we hold underneath is what we actually have exposure to. And I think that's part and parcel of reassuring you that it's the right type of product. Now, this chart would have definitely been relevant back in, let's call it March and April, a year and a half ago when COVID first hit. Now, we talk about the fixed income market and general liquidity and what you and I at home are able to see in the market or back-end trading. A lot of the fixed income products available actually went no bid, or they were halted. So there were a couple of days there where I had clients phoning us because they either wanted to buy a bond that they couldn't, or they wanted to sell a bond that they weren't allowed to because there was no market for it. Yet what's unique is when everything came under significant pressure, you could still trade the ETF that tracked those underlying securities. So in saying that, yes, there was liquidity, yes, you could trade that bond portfolio, and the way it behaved in terms of its pricing relative to the underlying securities that may not have been trading that day is you would have seen the spread widen. You can see here March 16th, March 18th, March 20, you can see the spread And when I say spread, that's how much the underlying bond portfolio is worth versus what you might be paying, or if you're selling, the price that you're going to be trading at. So it's just a discrepancy between the two. And it's interesting because when risk comes into the market and the markets actually become illiquid, we were still able to deliver on our promise where clients were able to buy or sell the ETF. So I think that's incredibly important because that's one question I would have had at literally every presentation I've done in the last decade around how are these instruments going to behave when risk or volatility or stress comes into the market. And I can tell you there hadn't been a more dramatic trading period than what we saw back in March and April of 2020 versus the credit crisis. But I think because the advent of ETFs and the size of the business today, it was very much under the spotlight. So I think it was a really good experience for most of our clients, and they were very keen to be able to trade those positions as they could. Looking at ZAG, and you can see ZAG is probably the biggest fixed income product in the country now. It's very boring. All it does is track investment grade paper in Canada. It's incredibly inexpensive. You can literally buy a well-diversified Canadian fixed income ETFs with one ticker. So that's what we love about it, and we love the liquidity around it. Now this chart, if you're not familiar with the Bloomberg screen, all we're trying to do is show you that over the course of 5 minutes, we were able to trade over 25 million of ZAG for one of our clients, and you can see the bid-ask spread barely moved. You can see from very bottom of the screen, 1221.43, it was trading at $15.63, and then looking at 4 and 5 minutes later, you were trading within, well, again, you can see 1563 to 1564 at the top of the page. So that's the point. The point is we weren't influencing the market. Someone didn't do a big ETF bond trade and all of a sudden the actual price or the discrepancy between what that bond portfolio was worth was negatively impacted. It wasn't, and that's what our team is there to do. It's there to manage that risk for our clients as they buy or sell ETFs. Now this is a page, now it's not so much branded for us, it's actually more of a tool that I want to encourage you guys to use. A lot of the time I'll have clients that are on their, let's call it predominant desktop, trying to trade a position, and they're just trying to get a sense of what the volume is. So what's actually out there, what's available to either buy or sell. So what's cool is you guys can go to both of these, stockwatch.com, you can go to Quote Media. These are free services. And what they'll do is instead of only showing either the NEO or the TMX volume, they're going to go into the sub exchanges. And some of you may not even be familiar with them, but they're actually listed on the left hand of the screen here. The Alpha Exchange, the Chi-X Exchange, NEO's newer to Canada, but also becoming very relevant. And again, it just gives you a more clear picture on what's in fact happening behind the scenes, because even myself, I'll do some of the buying or selling on my own here with my platform that I subscribe to. I don't always see the full depth of what's happening as far as buying and selling of a particular ETF at any given time. So if you're genuinely interested in that, and not all of you will be, but if you are and you want to get a much more granular sense of what is going on behind the scenes, you get a really good snapshot and picture of what is the true liquidity of a product at any given time. Call it the secondary liquidity, back to that chart we talked about earlier. I'm going to close on this. This is a chart that lists the most, I say liquid, but also the largest ETFs in Canada. Anything in blue, absolutely, that's BMO, but we've also listed third-party product here. Now, we haven't done it by category other than broad categories. So you'll see equities, fixed income on the top right, and then you'll see just below that fixed income, more so on the full-term Canadian fixed income as far as duration is concerned. And all we're trying to do here, I'm not promoting any one product, but I think it's a great cheat sheet for you to use if you're literally doing your homework or you're just getting the ball rolling and you want to know what the biggest Canadian index-based products are. Everything's going to be listed here. So it's a great reference guide that you can grab from our website. I think if you email Larry, or it might even be your package for participating today, do use that. And it also lists pricing, and it gives you a sense of how many millions would trade in a particular day. So again, depending on how much research you want to do, the tools are definitely here for you, and they're all free for that matter. And that's what we're doing here today, is the educational piece. So that's my 10 minutes. I'm going to hand it over to the boss, Larry Berman, and his guest, Larry. And thanks very much for having me, guys.
Yeah, thanks very much, Rob. It's really a great kickoff to our series here. A little bit about ETF liquidity. There isn't a week that goes by on BNN where someone doesn't email in or tweet at me or something asking about, an ETF doesn't have a lot of volume. Is it safe to trade and things like that? So hopefully today's educational piece covered off a lot of that. Very often we accumulate, questions and kind of try to answer them in different formats. So thanks again to BMO ETFs and Rob Butler for his great explanation on ETF liquidity. So getting into the presentation tonight, I'm so excited. My Larry brother from another mother. We probably met a good 10 plus years ago, and I've been a subscriber to Larry's research for a long time now, and we have these periodic chats. But Larry runs a chat room on the Bloomberg infrastructure daily where he's just discussing all the relevant things that are moving markets on any given day. And before I really formally introduce Larry here, today's agenda, we're going to talk macro markets. We'll get a little bit micro, but really we're going to stay macro. Larry developed a systematic way of looking at things that he calls the Lehman 21 systemic risk indicator, and I have a similar type of thing, which you all know, called the Pro-I series, and I'm going to touch on that a little bit. But I want to introduce Larry, and I want to take you to a time that was in early September, August of 2008, and our guest tonight, Larry, was sitting on the credit desk of Lehman Brothers. This was one of the epicenters of the great financial crisis, and Larry will tell some stories about those days, but he was actually called to testify in front of Congress on some of the nonsense, I guess, if you will, of the day. He wrote a book called The Colossal Failure of Common Sense, and it reeks to me today, Larry, that we're in a similar place here in the world where there's just a lack of common sense as it comes to investing. So, without really, highlighting all the specifics of your extensive resume here, Larry's had an incredible career in the markets, and we're gonna talk macro tonight. So, Larry, welcome. And really thanks for doing this and kicking off our series. I know I did a webinar, and you do a bunch of these things, and we did one a number of months back, and we had a great time talking about what was going on during the day. But I created an index about 25 years ago that I based my CMT paper on. And we call it the Pro-I's, and it's about probability. It's about what you do and what we think about every day. And a headline goes off, and what does that mean for markets? So when we're in the red on our indicator, we're in a high caution zone. We want to be a bit more risk averse. And right now our indicators have come back more into the neutral zone. We have 20 factors in ours, so you top us here, Larry. You got 21. But we look at 4 fundamental factors of valuation. We look at 4 business cycle factors, and we look at 12 technical factors. And right now, overall, we fall into the neutral zone because we've come off the boil a little bit, right? We've had this correction off the highs, and we'll talk about this. But I want to kick it off with this chart because as I was preparing this today, I saw you had put some stuff in the chat box after the market closed today, and it was really, we're looking at the S&P 500 Spider ETF here, and I looked at the pattern, and we call this in the technical world a gravestone doji. What the bleep is a gravestone doji? But it has meaning. Right. So talk a little bit about today's price action, maybe, Lair, and what kind of happened to create this behavioral pattern that we see here?
Well, thank you, Larry, and thanks. So it's a pleasure to be with you. And I really love your platform in Canada. I think you've really changed the game in so many respects, and I really appreciate the inspiration. So, we're talking about a market psychology of buying the dips. It's been around a long time, and especially around the 100-day moving average. And so you just have this colossal audience of investors that gets bigger and bigger and bigger that's been buying the dips. And this time, the 100-day and the 50-day have been struggling a little bit. And this time we also have a Fed that's potentially pulling back accommodation. So we're much closer to a pulling back of accommodation than we have been the last couple of years. And technically today we've tried to bounce like 3-4 times in the last 5 days, and today was really pretty ugly. And there was just look at the Nasdaq. So in the Nasdaq itself, 1,076 stocks inside the Nasdaq were down or flat on the day. 1,076. That's out of 1,755. So most of the stocks inside the Nasdaq were down or flat on the day, but the index was up 1%. So that tells you that, and this has been going on for a long time, the breadth is really, really ugly underneath the surface, and we're bouncing, but at the end of the day, we're failing at these levels that it speaks to. It reminds me a lot. I think we're like the first quarter of 2000 right now, where we're trying to bounce, and there's just a lot of pressure. There's just more sellers than buyers across the board the last several weeks, and I don't think that's going to go away anytime soon.
So you've called your research service that you started in 2010, I believe, bear traps. What the is a bear trap? Well, I looked at the chart today and I go, that looks like a bottom there. We have this bullish engulfing pattern. You talked about buying the dip there, and all of a sudden we get up to this trend line and they sell into it, right? So a bear trap is it's the bottom, but it's not a bottom. Right?
Yeah.
So do you look for bear traps? Like, tell us a little bit about bear traps. What do you do there, Lair?
Well, we have a Bloomberg chat, as you mentioned, with 665 or so institutional investors. So hedge funds, mutual funds, pension funds. That's 90% of our revenue. We started in 2010. We had just a couple of guys. You were back in the day, early. But now we have about 660 in about 23 countries. And out of that, what we've done over the years is, let's just say you were a hedge fund manager and more capital in New York for 10 or 20 years, and then you retired to the south of France, and now you're running the family money. That person will give a discount to, but they have to contribute. So out of the 660 institutional investors in the chat, we have about 65 incredibly brilliant family offices, contributors. These are grizzled veteran traders, either in rates, foreign exchange, equity volatility, credits, or high yield distress. So we have, out of that 660 or so contributors, we really have a number of talented people in each asset class around the world. And so what we do is we host a live chat during the day, and then we recap the chat for the retail audience. So on the other side of the coin, we have about 700 to 800 retail advisors around the world and high net worth people. And what we want to do is give that group of people a lens on a buy side conversation. Cut out the sell side, and just show the investors, what are the buy side portfolio managers discussing today. And that's really what the Bear Traps report's all about. It's about the democratization of information.
Great. So there's a website there. You can Google Bear Traps and find Larry. If you're on Twitter @ConvertBond, Larry's a must follow on Twitter. One of my favorite guys to follow and talk markets with. So let's get into the Lehman risk indicators. So here you've got you talk about market breadth, with the Nasdaq today, and we've got this advanced decline line, and the trend's been pretty strong, but it's looking to get a little bit fragile. And you also, so I look at breadth in my indicators, and we look at volatility. So tell us what you're seeing here in the breadth of the market and the volatility.
Well, as a former Lehman trader, Larry, our book's now in 12 languages, and I tell my wife once a month, I said, honey, if we sell 1 million books, we'll break even on our Lehman stock. So
I can't, Larry, I can't imagine, having a good part of my wealth in a stock that went to zero. Or, well, I guess you got a couple bucks for it, but what a mess. But I know your book's been tremendously successful.
So thank you. And then one of the things we talk about in the book is volatility indicators. And so everybody looks at the VIX, and most people know that's the volatility index. But the steepness of the curve is important. And what all that means is there's the 1 and 2 month VIX future, and then there's the 6, 7, 8, 9, 10 month. So the VIX futures contracts are futures contracts, and you can look at the pricing of the short term VIX, which is the 1 or the 2 month, or the longer term. And what happens is when things start to get really, when encroaching real risk is coming at us, what'll happen is billionaires like the David Teppers of the world, hedge fund managers, Appaloosa, the famous hedge fund, they will deploy capital and they'll pay up for that front month protection, that first or second month. So what happens is when you're closer to real risk, the curve will flatten. And so people will pay up for the front month, and in the closer you get to real risk, at some point the curve gets inverted, like it did obviously during COVID. But so to your point, and you just laid out a beautiful example of your indicators, what I find is you don't want to be fully invested, Larry, when the curve is flattening or pretty close to flat. That tells you that there's really, elephants leave footprints. Billionaires don't like to waste money. If they're paying up for the front month, that means they see something. And so we measure that 2 month VIX future versus the 8 month. And in a healthy bull market, the 2 month VIX future the curve should be steep. Okay, it shouldn't be flat. In a healthy bull market that's risk on, and where you really can play from the long side, you want to see that curve at least 3 handles steep. So that means the 2 month VIX future may be, say, 14, and the 8 month VIX future might be, say 18. That's 4 handles steep. But what happens is that when risk is coming into the market, the curve starts to flatten because billionaires, hedge funds are paying up for that front month, and that tells you that there's near-term risk approaching. So right now, as you can see over in the bottom part of the presentation, that curve has been flattening for weeks now, and it told you there's a problem. And believe it or not, what's crazy is it was flattening way before the COVID outbreak. So, in other words, smart money saw COVID coming. You can see it right there. Smart money saw COVID coming. And so this is where elephants leave footprints, and you can see indicators right on the chart.
Well, so back then though, Larry, the yield curve had inverted already, right? We've got a tremendously steep yield curve. So, this flattening of the VIX curve can't be, the same. So each pass is very different. We see the curve inverted very briefly a few months ago, for maybe it was a day or two. So how do you know when it ends? Like you can't know, right? It just helps set the tone in the environment.
Exactly. In other words, you don't want to. There's never one indicator, but you want to have a basket of things like the top is important here. The advanced decline line on the New York Stock Exchange, the NYSE stocks, right? They're a great basket of stocks. There's an advanced decline. That's been rolling over since June, and in a really healthy bull market, the advanced decline, see that 50-day moving average? In a healthy bull market, you want to see the advanced decline line above the 50-day. But when it crosses the 50-day, and the VIX curve is is been flattening. That there's a, when you have one and one makes four there, like that tells you that your risk reward on the long side here is very poor. And what happens with bull markets is so many people have been buying the dips, right, for the last year and a half, and there's so many people bought into those dips. I think we're potentially close to a flush here, because that's been working for a long time. And if we fail in the next day or so, and that 100-day moving average is not a successful dip buy, then we're in for some real trouble on the downside.
So those recent lows, if they don't hold, that's a bear trap.
Yeah, well, typically what a bear trap is where the bears get sucked in to one of these downdrafts, and they miss the next leg up, right? That's technically what a bear trap is, where people get bearish on the dip and they don't buy. But sure, the bottom line is there's been a lot of successful dips. They call it the idiot line. There's a lot of dumb money out there buying these dips, and there's a lot of quants, and they've been successful. But the problem with these strategies, Larry, is, as I've watched your show, all these times they'll make money, and then they'll give it back in like 2 weeks. And we're the risk reward here for that type of strategy, they've made money buying the dips, and then as we saw with COVID, that whole buying the dip strategy, 2017, 18, they made a fortune, and then they just literally gave it all back in 1 month during COVID.
So again, thinking about your time at Lehman and the housing market in the U.S., collapsing, and the CDS market, you specialize in convertible bonds. That was your pedigree for many years. And convertible bonds is, it's a debt instrument, but it's a leverage to how the equity of the company's doing. So you really focus a lot on credit. And so what are the credit indicators telling us about China and Evergrand and what's happening there?
Okay, so there's two things going on. We have the U.S. and inflation risk in the NASDAQ, and then we have this global credit dynamic with China. One thing to keep in mind is right now, if you look at global credit, there's 17 trillion in the NASDAQ 100, 17 trillion
of market cap.
Market cap, 17 trillion of wealth is in the NASDAQ 100. The XME, which are the metals which are exposed to China, that index only has 200 billion in it. The XLB, which are the materials exposed to Asia as well, that index has about 950 billion. And the XLE, globally exposed to China and credit, that has 1.1 trillion. So bottom line is, let's recap it. 17 trillion in the NASDAQ 100. That's mainly it's a huge pile of capital, 17 trillion betting on essentially deflation. Whereas if you look at energy, materials, and mining, that's only $2 trillion, 2.2 trillion. So you have a tremendous amount of capital in the world that's been betting on deflation for a long period of time. And so the reason why we track this is you've got to look at credit in Asia, because the commodity space is exposed to this, right? So you have the right here, the Asia high yield index versus the US. So clearly in the Asian market, especially China, there's your average high yield bond in China is like 12%. In the United States, we're less than 4%. So there's a huge spread between.
Thanks, Jerome.
Yeah, exactly. Yeah, thanks, Jerome. Yeah, Powell, promised to buy high yield. The Fed didn't buy that much, but because the bazooka was sitting there in the holster, the U.S. high yield market was really distorted. So here you have HSBC CDS versus Asia credit, and for the first time in a while, you're starting to see a little bit of widening out in that HSBC. So you want to watch HSBC carefully, because that's a bank that has a lot of exposed to China. So what we did, think about Lehman. In the Lehman era, the U.S. banks were underperforming the Asian banks. Okay, so if we were holding this show in the summer of 2007, the U.S. bank CDS was underperforming the rest of the world, because the US banks were closest to the epicenter. So if China is really a Lehman event, you expect to see substantial underperformance. And if you look at the bottom chart there, you see Standard Chartered versus Goldman. The last time China really blew up was 2015-16 there was a credit crisis and a currency devaluation. And so you can see there, what was fascinating is Standard Chartered, which is a bank which has tons of exposure to China and tons of exposure. Standard Chartered is right next to, if China's an epicenter, Standard Chartered is going to show us something, right? So if you look back to 2015 in the summer, way before the debacle, like in the spring, summer, Standard Chartered, if you look in the bottom part, the purple was underperforming Goldman dramatically way before China blew up. So somebody, had elephants leave footprints. They, people were really betting on a problem in Asia, and that was a great early leading indicator. Today, if Evergrand's got a problem, but if China's really going to be a Lehman event, we should see Standard Chartered and HSBC substantially underperform U.S. banks. And as of right now, they're slightly underperforming, but it's not meaningful yet. So this is something where if the credit contagion is going to come out of China, it's going to show up here.
Right. Okay. So this is something to watch. So the average person at home can't follow this, right? Like they need a bear traps report so they can they can see these things. Now you and I have Bloomberg terminals, so we've coded all this stuff up and we can follow it. But rest assured on BNN, if we get some alarm bells here, we'll certainly talk about them for sure. Okay, so next thing here. So you talked about being bullish on commodities or the underinvestment in commodities, and one of the narratives that you've put out recently, which I kind of like, I borrowed it from you, thank you, talking about the ESG mistake. Not that ESG is a mistake. We do care about the environment. We do care about governance of companies and the social things that companies do. But the underinvestment in commodities, and specifically carbon-based commodities, has caused a bit of a setup here for things like coal and other assets. So talk a little bit about this thing.
Well, if we think back to 2014, which was the CapEx high for oil, and CapEx just means capital expenditures, investments, exploration for oil and metals. If you look at 2014 numbers to today, we are about $2.4 trillion off of that path. So in other words, if we had just stayed on that plane,
if the trends continued,
yeah,
it would be $2 trillion more investment. So
exactly,
we've underinvested a lot for years. Okay.
That we have literally and think about the world population is up hundreds of millions since then. Hundreds of millions. Let me give you an example. There's 1 billion people in China without an automobile. There's 1 billion.
Staggering number. Staggering. Like, don't Americans have 3 cars each?
That's the thing. If you do the math, if China gets anywhere, the amount of automobiles in China are already greater than the United States, but there's 1 billion human beings in China without an automobile. In India, there's 1 billion human beings without air conditioning. In a country that is just extremely hot.
I was in Mumbai in 2012 doing a speech at the Bombay Stock Exchange and toured around a little bit there, and the humidity is so. Yeah, air conditioning is something that they are going to be investing in big time.
So the ESG crowd, they mean well. These are really wonderful, beautiful people, and they have these targets out in 2050 where we're supposed to be carbon neutral. But remember, this crowd, and this is all part of my next book, and we Random House was our publisher. We have a book coming out next year, but this is a crowd, this ESG. If you go to the Davos thing, I'm sure you've been to the Davos events, so where the globalists hang out and these are really global planners. They're trying to plan the plan the world for us. I mean, there's a really backstory here. These people have taken, because of the WTO and global trade and the decimation of the US Rust Belt, 7 million jobs have left the United States over the last 20 years, 7 million, and they've shotgunned these jobs all around the planet, okay? And so if you drive upstate New York or Pennsylvania, Michigan, Wisconsin, Pennsylvania, the Trump states, you'll see, I mean, ghost town after ghost town after just, you know, families addicted to opioids. You know, opioid deaths in the United States 10 years ago were like 5,000 or 10,000 a year. Now we're doing between 50 and 60,000 a year in recent years of opioid deaths. So fathers that leave their homes in the morning, Larry, and they go to the library because they don't want to, they can't even face the family thinks they're going to work, and they're going to a library, and it's just so sad. But the good news is we pulled 500 million people out of poverty globally, right? So the central planners accomplished their mission, Larry. They decimated the United States, but they pulled, and that's what they'll tell you at the cocktail parties in Davos, they pulled 500 million, 600 million people out of abject poverty. But the problem is, when you pull 500 million people out of poverty in the world, you created a whole explosion of a middle class. And guess what those middle class people want? They want air conditioning. They want an automobile. So the globalists have these agendas which are completely diametrically opposed. So if you do the math within all the global agendas, this is going to blow you away. There's a numerator and a denominator. If we're going to get to carbon neutral by 2050 on the planet Earth, the carbon usage and growth in emerging markets in all their models is actually flat to down. So the globalists that pulled 7 million jobs out of the US and shotgunned them around the world, that pulled 500 million people out of poverty, they're assuming no growth in their assumptions to get to carbon neutral 2050. So there's a huge problem here, and that's where you get into the ESG backfire, where they're just dramatically underestimating the amount of energy. There's 200 million people in India, Larry, without electricity at all. Okay, so the central planners of the world have made a colossal miscalculation, and this is going to fuel a new, for the first time, a much more sustainable inflation path than we've had in recent years.
You know, I don't disagree with that, but with all the debt in the world, you know, someone wrote in a question here. It's like, when is all this debt gonna blow up on us? So, you know, you've got this growth headwind of debt, and so you really have a scenario where interest rates, because of all that debt, have to stay at zero. They can't fight inflation if it ticks up, and potentially with all this underinvestment, you're going to see very, very high energy prices. So is that stagflation?
Well, it hurts profit margins for sure. So if you look at, in February, the street was looking for $200 of S&P earnings this year, and this year was like 175, and now they've taken it from 175 to 200, and for next year that was 200, and now it's 220, 230. So the S&P 500 expectations in terms of earnings are very high. They've ratcheted them up, and they're not. You know, we have a new kind of, you know, profit margin pressure coming from labor. So minimum wage in Amazon's up 20, 30%. You saw FedEx is having, so what's happened is the US has created such a beautiful, gorgeous safety net that, you know, getting people off the safety net, off the couch, off the beach into the labor force. There's still 5.5 million people, maybe 6 million people that have not come back to the labor force since 2019. So it's very difficult for these companies to pass along these prices and also bring back labor. And that's so that it's almost like the Phillips curve, which has been almost dead. It's going to come back to life because companies are going to have to pay up to get these people back into the labor force. But your point around debt is important, right? The Lacey Hunts of the world, and there's a lot of brilliant fixed income prognosticators, and their point has been for a long time that there's so much debt that interest rates will have a very difficult time going higher, because central banks know that let me give you an example, like a 100% move up in rates today, because of right now there's an extra 30 trillion of bonds that are below 2% in the world today. So from 2018. So from 2018 to today, there's an extra 35 trillion of bonds below 2% in coupon and yield. So if rates go up today 1%, the wealth destruction power of a 1% move is equivalent to like 300 or 400 basis points in the 80s. So to your point, the central bankers have to somehow protect that. That's setting up a really bullish dynamic for gold and gold miners, because if the Fed goes on a much slower taper path, or if they have to back away from that taper and really hold down yields, then gold and gold miners will be up 50% from here.
Yeah, the gold sector, gold stocks are the cheapest asset class on the planet right now relative to the revenue stream or potential. But it hasn't worked in a year. Like it's a great trade. I talk about it every week, but it's not working. So I agree. Someone asked a question on Bitcoin.
Yeah.
Is Bitcoin stealing some of that? Are the cryptos stealing some of that money that might have otherwise gone into the gold trade?
Yeah, for sure. Well, two things. Number one of the reasons why it's not working is because when the Fed's pulling back accommodation, so say 2013, they did the taper, 2013, 14 in that realm when they were doing the taper, gold miners dramatically underperformed, and they had a huge drawdown, like a 50, 60%. But in the first quarter of 2016, when the Fed backed away from the path, gold miners were up huge. So today we have Bitcoin definitely pulling money out, but it's more about, I think, the NASDAQ going down. The NASDAQ dropped 8% from September 5th to the other day. And so it's about $1.5 trillion of losses, of lost capital. And out of that, a good chunk, this is like a casino, right? The Fed's still holding out accommodation. And it's like going from the craps table to the roulette table. You just have a lot of speculators that, okay, my software stock that's trading at 70 times sales, that's the same as crypto, right? It's like, so like, what's the difference between crypto and a software company that's trading at 70 times sales? It's the same thing. So the gamble, it's more like a bunch of speculators that the NASDAQ drawdown basically helped the crypto market, because people just said, I'm going to get off the craps table. I'm going to go over the roulette table.
So wait, you're saying this market's too speculative? Yeah, just
people trading crypto from home on their phones when they're unemployed.
Yeah, it's really quite something. Let's talk for a second about this debt ceiling and what's happening in Washington, because you partnered up with a firm called ACG Analytics, and these guys are ex-Washington people. They get to talk to Janet Yellen and like one-on-one, like you've been in meetings with these folks. So the intel that you get out of the policy side, how does that impact your systemic risk indicators? Talk a little bit about that.
Well, that's important because I've dedicated my life the last 10, 15 years to just really being at the intersection of public policy, so Washington policy and capital markets. And ACG has been extremely helpful to me. They have a team in Washington, they have a team in New York. And what happens, what I noticed over the years, working at Morgan Stanley and all these different companies, a lot of analysts in New York wing it on Washington policy. They're not in Washington, so you really need a team that's on the ground there. And so some of the big trends. So right now in America, the average millennial is hitting 41. I'm sorry, the oldest, not the average, but the oldest millennial is in their 40s now. And so in 5 years, the oldest millennial is going to be 45, 46. And so you have this huge group, and these are collectivists, right? These are not baby boomers are different.
Yeah, well, the average boomer is now 65, right?
Exactly, 65 and 70. So I think, but the oldest boomer is like 75, believe it or not.
Yeah.
So 10 years from 5 years from now, the boomers are going to be. So what's happening in America is we have a much more left shift, and they're really looking at the Constitution and they're saying, oh, how can I, how can we really bamboozle this thing? Like, they don't like the current rules. They want to change things like the filibuster. The founding fathers in America created all these kind of rules and laws that protect a democracy from destroying itself. It protects, really the abuse of power. So in other words, if you're going to spend $2 trillion, right, you should have a supermajority. That's the way the government, that's the way the United States of America was supposed to work, right, for the last 200 years. If you want to spend $2 trillion, you need 60 seats in the Senate and a big majority in the House. You can spend all the money you want. But this what's called reconciliation, which in the last 20, 30 years has only been used a couple of times. The Democrats, because they only have 50 seats in the Senate and they only have a tiny majority in the House, infantile. And forget about politics, forget about what party you're in. The Democratic Party has lost since 2014 9 Senate seats. So they were up by 9 in like the early 2010, 11, 12, and now they're 50-50. And the House, they had a huge majority under Obama, and they've given all that back. So right now the House and Senate are flat, and the Democrats, because they do control the White House, the Senate with the vice president, right? They want to spend $2 trillion, and guess what? They don't want to. They want to spend the $2 trillion, but they don't have a supermajority. So they're going to use reconciliation, and they're going to use it twice in the same year, maybe 3 times. So this is a tool that has been rarely used the last 40 years, and now they're going to use it 3 times, potentially a year and a half. And the beautiful part about reconciliation is all you need is 50 votes, 5-0. And they really have 51 because they have Kamala Harris, which would be the tiebreaker. So we're going to get.
That's if Manchin and Sinema go along, right?
Correct. So the Blue Dogs, these are Trump states, Arizona, Seminole, Tester, and Manchin. They come from blue states. Those are states that Trump won by more than 55, 60%. So they're very conservative states. There's a big battle on the Hill between progressives and the Blue Dogs, and behind the scenes there's a lot of controversy, and that's why the VIX has been elevated, because it's not just the media wants to tell you it's all about Mitch McConnell and Chuck Schumer, but it's really a deep divide within the Democratic Party that is big. But at the end of the day, this is a party that's been, they lost the 2016 election. They lost in 2020 with Trump on the ticket. They lost 15 House seats, Larry. I mean, this party, they really have to spend here. The entire Obama team that lost 63 seats in the House in 2010, the most since the 1930s, right? This team in Washington has really, if you talk to people on the Hill, they have to go big, and they're going to get Tester and Seminole up to probably $2 trillion. We'll get a deal which is going to be very controversial and a lot of rocky roads the next 3-4 weeks. But at the end of the day, we're going to get a $2 trillion deal. They're going to come together, and it's going to have a huge impact on asset prices. It's going to force the Fed into a very tough situation next year, because foreign buyers of treasuries are pulling away. We've done a $3.5 trillion deficit 2020, a $3.5 trillion deficit 2021, and now we're going to do another $2 trillion in 22. So that's $8 trillion of deficit spending in 3 years. Larry, after Lehman, we only did $3 trillion of deficit spending in 3 years. So we're going to go from $3 trillion of deficit spending in 3 years to $8 trillion in 2.5, to $8 trillion in 3. So bottom line is it's almost 3 times as much. So that's that's gonna put a lot of pressure on the dollar. Commodity prices and here's the bottom line point. There's 17 trillion in the NASDAQ 100, 17 trillion. And there's only 2 trillion in commodity type stocks. We are about to witness one of the biggest rotations. It's already starting from growth to value into commodity equities. Another like 4 trillion is going to leave tech and bonds, and it's going to go into stocks that are more like 1970s type stocks, where value stocks outperform growth. That's what's happening, and it's going to be triggered by all these events in Washington.
Ooh, wow. You know, I love this stuff. I always found the macro to be so interesting, but when it gets down to the micro, you say, okay, well, here's the environment, right? The graphics you have here is you're talked about the shift. So you've got uranium and you've got, you know, energy basically, and coal. How could you be bullish on coal there if the ESG world, like, I don't get it. Tell us how you're bullish on coal. I get uranium because that's kind of green, but how are you bullish on coal?
Well, another great indicator, Larry, and I think you gave me this years ago when we had that dinner in New York. You said, Larry, whenever they kill the ETF in a sector, get long the stocks. And about a year and a half ago, they killed the coal ETF. They right. took it out to the woodshed. They shot the coal ETF. So unfortunately, there is no coal ETF for us to show. So we had to show Arch Coal, Arch Resources. It used to be named Arch Coal, but they changed their name to Arch Resources. That's how bad coal was in terms of ESG.
If the coal doesn't work out, maybe they'll start mining crypto.
Yeah. But so what's happened here is, number one, met coal supports steel making, and right. thermal coal supports people in India buying air conditioners. So the bottom line is, you have a big dynamic globally where there's just not enough coal because you've taken so much CapEx. Remember that 2.5 trillion that's come out? Not most of it, but like a ton of CapEx. If you look at the CapEx destruction in terms of investments, a ton of it's come out of coal. And then you have countries like China and India that are cheating. Larry, these people sat down and in a Paris Climate Accord, right? If you look at what China's actually done in the coal space since the Paris Climate Accord, the media will not talk about this because it makes their darlings look like buffoons, right? But you sat down with the Chinese, they told you they were going to do X and Y, and they did Z on steroids. The amount of coal plants in China, they're up to 1,100 coal plants in China. Coal plants in China, oncoming coal plants are like 5 standard deviations greater than they promised the world in 2015, 16 during the Paris Climate Accord. So it's very clear to us that these emerging market countries, their electricity demand, and as a person, as a society goes from very poor lower middle class to middle class, the energy consumption per person explodes higher. And so you have this big move up in the middle class globally. At the same time, you've had this huge contraction of coal exploration. At the same time, you've had this new infrastructure deal in the United States where, there's 44,000 bridges in America that are more than 20 years old. That's a lot of steel. So the bottom line is, the picture for coal is beautiful. It's more bullish than ever right now.
Okay, so best way to play that for you is Arch, and the uranium side, you have a Uranium Etf, URNM. Is that new Sprott product?
Yeah, the Sprott team's amazing. I mean, they saw this coming. They have a uranium fund that buys uranium in the open market. It's almost like the GLD in the old days. So they have an ETF that it's not really. It's like, you would know, it's not technically an ETF, right? But it's it's a vehicle that will buy the commodity. So always remember, there's the commodity, and then there's the companies that either process the commodity, search for the commodity, enrich the commodity. The uranium miners, this whole space in uranium, the whole sector is only $32 billion. If you add up every company, the value of all the companies in the URM, it's $32 billion. Now, a year ago, it was 15, so this sector has doubled. But what we're looking at is, if you look at the NASDAQ 100 and then you look at commodities, there's a whole bunch of these sectors that are starting to dramatically outperform. And what I think is going to happen is, this is very important with Germany. Germany's supposed to take 6 plants offline in 2022, their last 6 nuclear power plants. And there's been such an energy crisis globally that we think that's going to be pushed back. So it's like 4 or 5 years. So the bottom line is, around the world, there's not enough coal, there's not enough electricity. And so that's creating an energy crisis that's going to massively increase the demand for nuclear power. And it's really the only way to get to that green meadow. And so that's why we think I think the URNM is probably a double from here over the next like 2-3 years. And this is the next slide is very important. So this is the Bloomberg Commodity Index. When you see 9% outperformance versus the NASDAQ in less than 10 days, okay? So we're looking for trend shifts here. And so this is really powerful. And that's why I love having you in the chat, because you'll point some of these things out to me during the day. I said, Larry, look here, we've got a lot of great contributors like you. And you've been the last like 6-9 months, you've been saying to me over and over again, watch the spread between, say, how are commodities doing versus the NASDAQ, and what's the trend change. And as you can see, those yellow dots, they happened like around in the late 90s. We had a big shift from growth stocks to value stocks. And now we're seeing the commodity, it's very same types of things we saw around that time, where the Bloomberg Commodity Index has had a number of days where they're dramatically outperforming the NASDAQ. And to have 9% outperformance in less than 10 days is spectacular. And so this is important, because for the last 20 years, bonds, like when Lehman failed, if you had a 50-50 portfolio, say you had $1 million, you had $500,000 in bonds and $500,000 in stocks, right? The day before Lehman failed. Your stocks went down 50% after Lehman, but your bonds went up quite a bit. So you lost so you have $1 million, $500,000 in stocks, $500,000 in bonds, and your stocks went down to 250,000, but your bonds went from 500 to maybe 650. So your bonds offset 150,000 losses, right? Your bonds were your best friend. That's the fat classic 60-40. What's happening is this whole dynamic with the amount of debt, the ESG dynamic with suppressing capital expenditures, suppressing investments, that's creating this whole energy crisis. It's really changing. The 60-40 dynamic is dead. It's something that's worked for the last like 10, 15, 20 years. It's now toast. You need to be long stocks, bonds, and commodities. And what we're seeing is the amount of times in the week and the month, and you pointed this out to me last week, you said, Larry, look at the correlation between the TLT and the QQQ. And I really appreciate you're always pointing it out to me, because if the correlation between the TLT, which is a bond fund, if that's positively correlated, so if bonds are moving down with stocks instead of negatively correlated as they were in 2008 when stocks went down, bonds went up, here positive correlation is a big problem, because it wipes out, it's basically like a wealth destruction vehicle when you're positively correlated. And if we go back to the 70s, there was bonds and stocks during a high inflation commodity boom, bonds and stocks moved up and down together. They weren't negatively correlated. And that tells me we're in for a big change in asset allocation.
Yeah, I have to agree with that. I've been talking about it for quite a long time. And the complicating factor, the comfort in bonds was that you got a real yield. a positive real yield after inflation, and that's gone. There isn't a basket of bonds you can buy today that gives you a yield, not a coupon, but the yield that you're going to earn that's higher than inflation. So you've got a whole asset class that's literally been wiped out, and there's never been more debt. It's just quite a mess. So we got about 20 minutes left, Lair, and we're going to do some questions here. So a couple people have written in already. Someone's asking about natural gas and how do you determine when it's overbought or oversold? And I think the bigger question here, not so much about natural gas, but we can answer that, is how do you trade it? And you and I have very similar styles. We like to scale in and scale out. So if you have any thoughts on natural gas, share them. But how would you trade something like this?
Well, nat gas is, and you're the perfect person to talk about this. But the problem with I think it's the UNG ETF, is there's a lot of roll bleed in there where. So if you run these ETFs that are in commodities, the problem is you got to go into the futures market to get your shareholders exposure. So one of the problems with the UNG is that portfolio manager has to constantly roll. So they're buying the front month natural gas future, and then 30 days later that expires. They got to get out of that contract and buy the front month. So they keep rolling the front month. There's a real expensive cost to that. So over time, if you're in some of these commodity ETFs, there's a big decay factor. But if you can catch a short-term trend, they will do really well in the short term. So if you catch a short-term, like say a vicious 20-30% move up in natural gas, and you're long the UNG, you'll do pretty well. But if you're in the UNG for a longer period of time, you're going to underperform by a lot, and that's where you'd want to be in the futures market versus the ETF.
Yeah, part of the question here is the nature of the global scope of natural gas. So what's happening in European supply is translating into U.S. prices, right? Because commodities are commodities. So if it's moving in one market like the UK, then it's going to have spread effects in other markets like Brent versus WTI, etc. So
yeah, I mean the UK. I mean there was a wind drought in the last 6 months. Wind production has collapsed, and it's put a lot of pressure on natural gas demand. And at the same time, the rest of Europe is now coming out of COVID, so your demand for electricity is exploding, and this whole ESG thing has been sitting out in front of this emergence from COVID. So it's a perfect storm where you have suppressed exploration globally, and you have billions of people. There's literally now 6 billion people have been vaxxed. That's about 6.4 now per Bloomberg. So 6.4 billion human beings have had one shot, at least one shot. So you've got this huge emergence, and so natural gas, like you said, natural gas surges in Europe are much worse because remember, they don't really have, in the United States, we have the shale region and we have we're like Saudi Arabia of natural gas, but in Europe, they don't have a lot. So they have to import LNG, they have to import natural gas from around the world. So they have even on a good day, there's European natural gas is always $3 more than US. But now it's a $15, $16, $20.
Yeah, so lots of factors here. So as a pure chartist, it becomes very, very difficult to summarize the question here. Someone's asking about some of the junior exchanges in Canada, and I wouldn't expect Larry to answer this, but Rob in his presentation from BMO did talk about some of the junior exchanges, and so don't worry about the volume there. Are they safe? Yeah, don't just we shouldn't worry about it. Would be the message there. There's all kinds of exchanges, coming open, and I think there's more to come. Someone's asking about an ETF here that uses a little bit of leverage. It's a dividend payer that I think it focuses on some of the Canadian dividend payers and uses some leverage.
It looks like a plug, Larry. Someone's got a plug.
Yeah, well, it's going to, a modest amount of leverage, 130, like 25, 30% leverage. It can be opportunistic, but you don't want to get into a product that uses a lot of leverage to specifically juice the yield and make you think you're going to get, 8, 9, 10%, because when you go into a risk off, you're double leveraged, and so you're going to have way more volatility. But that's a pretty good question there. XSH, is that a good holding for 10% of my fixed income? What XSH is, Lair, is a short-term corporate bond ETF, and so the question is short-term credit investment grade generally a safe investment for fixed income?
Well, there's a lot of people in those. The problem is there's so many people that have moved into, first of all, they've gone into corporates because treasuries are so low, and Europeans are in a problem because there's anywhere between 14 and 17 trillion of negative yielding bonds. So there's all these people in the world that are reaching into corporates. And I've been looking at, we've been recommending recently the IVOL ETF because it's an ETF that will benefit in rising inflation, and you're not exposed to duration risk the way you are with some of these corporate bond ETFs. You can buy these short-term ETFs, like the ETFs with less duration that are corporate bonds. The problem there is if you go into a credit cycle, all the bonds are trading so high in price. So in other words, what happens with corporates is the closer you get to maturity, the closer these things trade to par. So if you come into any kind of credit dynamic where there's a credit potential crisis in the United States for some reason, those short run bond funds that are in corporates could get really a decent drawdown because the bonds in the portfolio are all trading at par above.
Yeah, so this is a common problem for everybody. The next question here is a key one. So here you have a 70-year-old person saying, can I make a recommendation of what dividend funds I can go into or what stocks I can buy? Generally a 70-year-old would think about putting 70% of their portfolio in bonds, right? Get some good corporate bonds and get that coupon. And the whole dynamic, the whole problem with 60-40 and balance today is that the central planners, like you don't think we're living in social democracy here, but the social planners called central bankers are anchoring our interest rates to such a low level because of all this debt. The interest rates are just going to stay low forever. And that's going to force more and more people and older people into equities. And so can you handle the volatility at that stage in your life of equity risk when you really don't want that in your portfolio? And this is a big problem. Do you have any ideas for folks here on what to do where you're sitting in retirement and you need a coupon to live off of?
Well, I like to look at strong balance sheets where stocks are off 40%. And so we have a model that looks for those. Newmont Mining's been coming up like close to a 4% dividend. The stock is off close to 50% and very strong balance sheet. The one thing about the commodity space, because of the 2015 commodity crisis, 2015-16, and then we had COVID, and we've had multiple crises in the commodity space for like the last decade. We've had a number of shocks that have made these companies, these CFOs, these chief financial officers of commodity companies, these people have been through the ringer. So they're risk management of their balance sheets is better than ever. And so I would, work with the financial advisor, work with people like Larry on, looking at companies that are on sale but have strong balance sheets, and that's Newmont Mining is one of the best I can find.
That's one of my. I mean, that's what I do. I look for companies that we take the Russell 1000 and we screen it for quality. So you get rid of the bottom half of companies that have bad balance sheets and they don't have good return on equity. So all of a sudden you're in the top half of stocks, and then we take that universe and say what's on sale. Right?
Yeah.
Where the risk returns are a little bit better. And that's kind of what we do in our stock portfolio.
And with Newmont, you're getting almost a 4% dividend. I left the dividend out.
And that's a great way to play. But the volatility of a gold stock is going to be way more than a corporate bond, so you know. So you got to be okay with that. Someone's asking a question, Larry, about the euro, right? The US dollar versus the euro, and saying it looks a little cheap here. Do you have any thoughts on the US dollar overall and currency?
Yeah, I like the euro here because, like I said, the US is doing $8 trillion of fiscal, and the global economy is coming out of COVID. So there's when you look at currencies, right? There's 64 trillion of GDP outside the United States, 64 trillion, and there's 20 trillion inside the United States. So 64 trillion out, 20 trillion in. So what happens is when you come out of a COVID type dynamic, when you go into COVID type dynamics or Lehman shocks or any kind of global shock, the dollar it's the safe haven. But as you naturally come out of that shock, there's a migration into global currencies that is typically just strong as it is. Like, in other words, that naturally will happen. So that's a force that's going to be good for the euro. But then you take the backdrop around the United States and the 8 trillion of fiscal in 3 years, and the trade deficit and the dual deficits. There's just global investors are not as comfortable with U.S. Treasuries as they were in recent years. And for the first time, what's amazing about Europe is they're starting to do more fiscal, they're starting to spend more on the fiscal side. So that means there's less what's called fragmentation risk that you and I, you've been a client for years. I remember we were talking about in the chat during the Greek crisis. So there was a lot of fragmentation risk where Europe was going through such an austerity period. They're forcing austerity on the periphery, and that was creating people that want to leave the euro. Now you've got a left-wing government that's now taking over in Germany, very much more progressives. The Black Zero crowd in Germany, these guys have been pushed out of power. This is a huge, huge change what's going on in Germany. CDU, Merkel, all these austerity hawks have been neutralized in Germany. So Germany's going to be a lot more conducive and supportive of spending. So that Europe as a whole is going to have to issue more debt. Guess what? That's a competitor for the U.S. Treasury that the U.S. Treasury hasn't had in recent years. And so the dynamic is going to pull a lot of demand for bonds away from the U.S., and that is not good for the dollar. Good
and I see that as well. But yes, Treasuries, you're picking up 170, 180 basis points on a U.S. 10-year over still a negative Bund. So that's for the average investor, that's not a trade to make. Institutions see it a little bit differently, right?
True, but you're right. But as the countries in Europe issue more paper over the next couple, there's going to be higher yields there, and so those higher yields there are going to drive up yields in the U.S., I think.
So the way to play that, FXE is a Euro ETF that trades in New York. If you want a bullish position on the euro, FXE would be a good way to play that. Let's see. Deborah is asking about another currency-related question. Does the increasing adoption of crypto threaten the dominance of the U.S. dollar as the reserve currency, unlike gold?
No. The problem with crypto is 470 in the last, since 2017, you've had 3 or 4 70% or more drawdowns. So crypto volatility is light years away from offering a stable reserve currency. It's just, you can't have 3 or 4 70% drawdowns since 2017 and expect anybody to store wealth in that asset.
Yeah, I don't disagree, but it is interesting to see some pretty big name people on Wall Street, be quite supportive of crypto in general. Let's see, what else do we got here? Someone is asking a question on the ETF that I manage, and that is ZZZD, and they're asking about the AUM in ZZZD. So just if I can answer that. So I think it's around 60 or 70 million in that ETF, but that ETF is a unit of the underlying mutual fund that supports it, and in that mutual fund, we're looking at about 350 million in that. So, pretty decent size fund overall. And ZZZD, the ticker, sleep at night dividends, ZZZD. I really like the ticker we picked.
I love that name.
Yeah. Okay. Let's see, what else do we got here question-wise? Someone says, well, thank you, Davos, very much. Okay. What else do we have? Markets. Oh, okay. So very specific. What's going to happen in the next 3 weeks? Someone says, okay, great. You've talked about all kinds of political stuff, but what's going to happen in the next 3 weeks?
Okay. I can tell you exactly what you're going to have. Mansion. So the way Congress works is the mansions, the blue dogs, the mansions that, like you said, we don't get the $2.1 trillion. Now remember, the progressives want 3.5 trillion, and the bid offer is 3.5 from the progressives. The blue dogs really want $1 trillion. They'll meet somewhere in the middle. But to get the blue dogs to vote with the progressives, the blue dogs have to put on a show. So what I mean by show is they have to put up a kind of not a phony, but they have to basically put up a fight to show their base. Or it's a Trump base in all these 3 states. The blue dogs are from your Arizonas, your West Virginias. So the blue dogs will put up a fight, and that fight has to be in the public eye. So they have to put up a public fight. So volatility, you want to be long vol. We're long the VXX, because for the next 3 weeks, both of these sides are going to be fighting it out. Eventually, you'll get a deal. But the debt ceiling thing is another problem for the first week of December. So we'll get a deal toward year end with a lot of volatility between now and then, because both sides will be taking shots at the other.
Gotcha. Okay, so we got 2 minutes left here. I need a minute to wrap. I'm going to hold you to your next market call here. S&P 500 chart up in front of us. Do we test the old highs before we test the 200-day average? Currently, that 200-day average is tracking at 4150. So do we see a dip below 4200 before we see a retest of the highs?
I don't think there's any way, with the debt ceiling in December, with this inflation shock that's going to bring, we have the earnings that are going to come out in a week, and these companies are going to, we already saw FedEx warn, we've seen Amazon warn in terms of, there's been the Costco, this is going to be an earnings disaster, because labor costs are up, and natural gas and oil, PPI, all those factors just crush your margins, and earnings expectations are the highest. So the market's going to look forward. The bottom line is we touched the 200-day before we reach the highs. And like you said, the 200-day is down at 41 something.
So Lair, thanks so much for being with us here tonight. Colossal failure of common sense. Follow him on @ConvertBond. Look him up at the Bear Traps report. and I think you have a silver level that you're thinking about opening. Right now, I think you're full on your subscriptions there, but you're thinking about opening that up again to individual investors. So, you know, I will tweet that out if you're going to do that, and maybe we can get a free trial for a month or something for some of our watchers here to follow you along, because I think you are by far one of the best macro guys out there. I'm very grateful for your friendship. Thank you very much, and it's you know, you're value added every day.
Thank you.
So for all you out there, thanks for joining us for this first episode. 10 weeks of this to come. Please, if you can, support one of our charities, leukemia and cancer research at the Sick Kids Hospital, Alzheimer's and dementia research at the Baycrest Hospital here in Toronto. And, you know, be well, everyone, and we'll see you next week. Thanks again.
See you at the top. Thanks, Larry. Bye-bye.